According to the CEOs of Canada's biggest banks, tens of thousands of Canadians could default on their mortgages as interest rates rise. In fact, Scotiabank alone estimates that 20,000 of their own customers are at risk of defaulting on their mortgages. That represents 2.5% of their borrowers. And on top of that, millions of others are at risk as their mortgages come up for renewal in the next 2 years. But the CEO of CIBC says that this is not a bank credit problem. This is a consumer lifestyle issue. And in his opinion, more money needs to move from discretionary spending to interest spending. And all of this has led to the banking regulator reevaluating its rules, including the stress test and some additional rules that they may put into place, which I'll get to later in this video. But before I get into it, my name is Nolan Mathias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit that like button so more people like you can see this video. And as a special thank you to all of you who have done those two things, I'm giving away the first 500 copies of my new book, Mortgage Secrets, at mortgagesecrets.ca. All you have to do is fill out the form and pay for shipping and handling, and it's all yours, but there's only 500 available. Okay, so let's jump into the news as Canadians brace for mortgage defaults. This seems to be the thing that a lot of people are afraid of, including the CEOs of Canada's 5 major banks. And I want to jump you in and show you some of the news articles here that have come out in the last couple of days. This one is of particular interest. Tens of thousands of Canadians could default on mortgages as interest rates rise, bank CEOs say. So this is coming out of a conference of the bank CEOs put on by RBC. So what they did, they put all of the CEOs of the banks in a room together and asked for their predictions. And certain bank CEOs are suggesting that tens of thousands of their clients are at risk for mortgage defaults. Now, there's a couple things to unpack here, because if you look at the news and you see 20,000 Canadians at risk for mortgage defaults, well, the numbers seem like they're way more significant than they are. Because if you look at Scotiabank, for example, which is estimating that 20,000 of their clients could be at risk, well, that only represents 2.5% of their borrowers. And what you have to keep in mind is that the majority of the people who are really at risk are the people who bought with low percentage down at the top of the market. The majority of Canadians, though, bought their houses leading up to the last couple of years, not in the last couple of years. So there are a lot of people who had variable rate mortgages or adjustable rate mortgages or fixed rate mortgages from 5-10 years ago who have a pretty significant amount of equity in their homes. And some of the bank CEOs are suggesting that the savings from the pandemic, as well as the equity in the home, mitigates a lot of the risk for a lot of borrowers. So there's just this small percentage of borrowers who bought at the very top of the market who the Canadian banking system is concerned about. However, what's interesting to note is if you take a look at Canada's default rates, and this is a chart, this is data, I should say, from CMHC itself. If you look at the default rates, and this is for the most risky borrowers in Canada, the ones who have the least amount of down payment, they're seeing very insignificant default rates. So this data starts in 2012. You can see that back then, the delinquency rate was about 0.38%. And if you go and you take a look at today, 2022 or Q3 of 2022, which is the most recent data, the data for delinquency in Canada is actually at the lowest that it's been in a decade. And the question is, why is this happening? Why is this the case for Canadian mortgages? And the reality here is that OSFI, which is the Office for the Superintendent of Financial Institutions, and the Department of Finance put in the stress test in about 2016, and most Canadians have qualified at around the 5.25% range, which is about where interest rates are now. And for those who have mortgages that are coming up for renewal, they will be renewing into rates that are very much in line with what they were stress tested at, which means that the majority of Canadians who got a mortgage in, let's call it, the last 7 years, have qualified in such a way that they should be able to withstand the higher interest rates. And we're very much seeing this in the default rates. A lot of people are finding themselves in a situation where they are okay. And keep in mind that the pandemic trained us to be able to not spend as much money, because when everything happened with the lockdowns in March of 2020, we all got really good at saving money really fast. So that, along with the fact that people have qualified at higher rates, seems to be providing some insulation to the Canadian real estate market. And this is contrary to what many news articles are suggesting. If you take a look at this one, mortgage defaults and foreclosures on the rise as interest rates climb. This is a really interesting article because there's actually no data here. The Financial Post put out this article. It is a sensational headline, and it is based on conjecture from mortgage brokers. So what they did is they interviewed some mortgage brokers and tried to determine if there were high rates of delinquency in the market. And on top of this, other news organizations have reached out to people that I know, asking for them to comment on delinquencies and people who are struggling with their mortgages. And the reality here is that there just isn't as much of this as we have seen in the past. Now, that's not to say that it won't happen as interest rates continue to rise, but as of right now, it seems as though Canadians are weathering the storm quite well. But that is not stopping the Canadian banking regulator from taking another look at mortgage rules. Now, this is the part that really concerns me. This is the Office of the Superintendent of Financial Institutions taking another look at not only the stress test, but other potential rules that they could put into place in order to curb consumer borrowing. And the piece that really bothers me is this section right here. The question in our minds is it sufficient? They're talking about the stress test here. So we will look at a broader range of debt serviceability tools, including debt to income constraints, debt service constraints, as well as the current interest rate stress test. So what you need to understand about the current interest rate stress test is that it takes the normal debt servicing rates, which are basically 39 and 44%. So 39% of your income can go to housing, and then an additional 5% can go towards your other debts. And it increases the interest rates that are used in that calculation. So basically it artificially lowers debt servicing ratios. And what OSFI is suggesting that they're going to look at here is, first of all, lowering debt servicing ratios. So when I got into the industry in 2003, they were 32 and 44 respectively. Now they're looking at the fact that they may reduce those. But here's the one that really scares me: the debt to income ratio. So this is something that we saw first in the first time homebuyers incentive that the federal government put out a few years ago. And what it did is it limited your ability to borrow to 4 times your income. And that basically made that program irrelevant because it allowed you to borrow significantly less than what you would qualify for under debt servicing rules and the stress test. So now OSFI is suggesting that they may be looking at a similar tool, which would have significant impacts on the Canadian real estate market. First and foremost, if let's say you were only allowed to borrow 4 times your income, well, a person who earns $200,000 would only be able to borrow $800,000, which is significantly lower than what they can borrow right now. But on top of that, it would have significant implications for real estate investors. Because let's say they put a debt to income restraint on being able to borrow. And let's say that restraint was 4 times your income. Well, even though you can use rental offsets to offset mortgage debts when buying rental properties, if they put a debt to income limit in place, that could essentially wipe out all of the ability for real estate investors to purchase additional properties and take on more than a certain debt ceiling, which, like I said, would have a significant impact on the Canadian real estate market. And it could quite possibly mean that a lot of real estate prices could collapse in some of the investor-heavy markets. Now, one thing that we know about any time that the government changes rules is it usually creates some sort of frenzy in the market and actually puts upward pressure on housing prices. And if OSFI were to make major changes right now, you can rest assured that that will happen. And it could lead to increasing prices temporarily or bidding wars in certain markets. So it's something to watch out for. And if OSFI does decide to make any changes and you think that you're going to be in the real estate market in the next couple of years, it is probably going to be prudent to act sooner rather than later. Now, my friend Tom Story and I, we had a brief conversation on this morning. He's going to come at this topic from a slightly different angle. When he publishes his video, I'm going to link it right here. But in the meantime, if you are one of those people who find yourself in a situation where you are struggling financially, or maybe you just want to have a little bit more room between your debt obligations and the amount of income you make, check out this video that I'm going to post up here on my Millionaire Mentor's secret system to managing your finances. And the truth here is that it works for anybody.